Hi, I'm Roger Montgomery and welcome to this week's Video Insight. Today we're diving into a topic that's got some investors buzzing, the shift from FAANG to Mango, and why this new acronym is defining the next era of economic dominance. Professional investors love a good acronym, and they love a winner even more. From the Nifty 50 to FAANG and the Magnificent 7, catchy names help us group the rockstar stocks that capture the zeitgeist of commercial performance or commercial power. A decade ago, FAANG, which was Facebook, Apple, Amazon, Netflix and Google, well, they were the gold standard, with market caps rivaling entire country GDPs. But markets evolve, and in 2025, a new acronym is taking centre stage, Mango. To be honest, Mango isn't brand new. In fact, back in 2022, a Bank of America analyst coined Mango to highlight semiconductor stars like Nvidia, Marvell Technology, and ON Semiconductor. Fast forward to today, an analyst Sterling Larkin has redefined Mango as Meta, Apple, Nvidia, Google, and the yet-to-be-listed OpenAI, the brains behind ChatGPT. Why the shift? It's not just a rebrand. It's a signal of a deeper transformation in the global economy. The move from FAANG to Mango reflects a seismic shift in value creation. FAANG stocks thrived on consumer platforms, subscriptions and ads. Mango, on the other hand, is about foundational technologies, AI, advanced semiconductors and cloud computing. These are the engines driving every industry from healthcare to logistics. Mango companies don't just sell products, they monetize innovation, building tools that redefine productivity and fuel economic growth. And here's where it gets really interesting for investors. Despite the Fed's aggressive 550 basis point rate hikes since 22, which should have crushed tech valuations, the S&P 500, led by Mango stocks, keeps hitting record highs. Why? Explosive earnings growth. Conservative estimates peg Mango's forward free cash flow at a 24% compounded annual growth rate, even with heavy R&D spending. Nvidia's 5-year growth exceeds 40%, and Meta's holding strong in the mid-teens. The kicker, of course, is these companies are getting more profitable as they get bigger, defying traditional business school logic. Normally, growth leads to mean reverting returns on equity, but Mango's network effects, data fueling better algorithms, attracting more users, generating more data, create a virtuous cycle of super exponential cash flows. Nvidia's GPUs and Meta's AI platforms aren't just products, they're self-reinforcing ecosystems. And they're not skimping on innovation either. Mango stocks allocate 22% of sales to R&D, triple the average of the S&P 500. This fuels breakthroughs at an unprecedented scale. Plus, geopolitics plays a role. In normal times, a company like Nvidia with an 80% market share would face antitrust scrutiny. But today, AI and semiconductors are strategic assets, like oil or steel in the past. The US isn't about to weaken its champions when global rivals are circling. The question, of course, is, are they in a bubble? Well, according to some estimates, a two-stage discounted cash flow model employing 18% growth for 5 years and then tapering to 7% indefinitely, which of course is a big ask, produces a valuation for Alphabet of roughly $220 a share, above its recent price. Nvidia, with faster near-term growth, appears 10% undervalued. These aren't meme stocks or NFTs. They're structural players in what could be the next industrial revolution. With AI and computing power reshaping what's possible, Mango stocks are leading the charge. And keep an eye on quantum computing too. Two of the best performing US stocks last year, up 10 and 20 times, are in this space. The future is here, and some say the future is Mango. Well, that's all we've got time for this week. See you again next week, and until then, please follow us on Facebook and X.